Welcome back to Caffeinated Money, where we explore the world of finance and investment strategies. In today's video, we will be discussing a crucial topic for any investor: diversification techniques. By spreading your investments, you can effectively manage risk and potentially increase your returns. So let's dive right in. Introduction to diversification. Before we delve into the various diversification techniques, let's understand what diversification means in the world of finance. Diversification is a risk management strategy that involves spreading your investments across different assets, industries, sectors, or geographic regions. The goal is to reduce the impact of any single investment's poor performance on your overall portfolio. The importance of diversification. Why is diversification so important? Well, as the saying goes, don't put all your eggs in one basket. By diversifying, you can mitigate the risk associated with individual investments and protect your portfolio from significant losses. Different asset classes, such as stocks, bonds, real estate, and commodities, perform differently under varying market conditions. By having a diversified portfolio, you can potentially benefit from the outperformance of some investments while minimizing the impact of underperforming ones. Techniques for diversification. Now that we understand the importance of diversification, let's explore some techniques to achieve it effectively. 1. Asset allocation. Asset allocation involves dividing your investment portfolio across different asset classes, such as stocks, bonds, and cash equivalents. The allocation depends on your risk tolerance, investment goals, and time horizon. For example, a younger investor with a longer time horizon might have a higher allocation to stocks for potential growth, while an older investor nearing retirement might have a higher allocation to bonds for stability. By diversifying across different asset classes, you can balance risk and potentially enhance returns. 2. Geographic diversification. Geographic diversification involves investing in different countries or regions. By spreading your investments globally, you reduce the risk associated with a single country's economic or political events. International investments can provide exposure to different markets and potentially higher returns. It's important to consider factors such as currency risk, geopolitical stability, and regulatory differences when diversifying geographically. 3. Sector diversification. Sector diversification means investing in different industries or sectors of the economy. Industries perform differently at different stages of the economic cycle. For instance, during an economic downturn, defensive sectors like healthcare or consumer staples may outperform, while cyclical sectors like technology or consumer discretionary may lag. By diversifying across sectors, you can reduce the impact of a particular industry's poor performance. However, it's important to note that diversification does not guarantee profits or protect against losses. 4. Investment styles. Diversifying across investment styles can also be beneficial. Investment styles include growth, value, and blend. Growth stocks tend to have higher growth rates but may be more volatile, while value stocks are considered undervalued and offer stability. A blend style combines both growth and value characteristics. By diversifying across these styles, you can balance risk and potentially capture different market opportunities. It's important to assess your risk tolerance and investment objectives when selecting investment styles. 5. Time diversification. Time diversification refers to the concept of spreading investments over different time periods. It involves systematic investment or dollar-cost averaging. By investing a fixed amount at regular intervals, such as monthly, regardless of market conditions, you can reduce the impact of short-term market volatility. Time diversification can help smooth out the impact of market fluctuations and potentially enhance long-term returns. Key considerations. As you implement diversification techniques, there are a few key considerations to keep in mind. 1. Risk tolerance. Understand your risk tolerance and align your investments accordingly. Some individuals may be comfortable with higher risk investments, while others prefer a more conservative approach. Diversification should be tailored to your risk tolerance to strike the right balance. A financial advisor can help you assess your risk tolerance and guide you in building a diversified portfolio. 2. Regular monitoring. Regularly monitor your portfolio and make adjustments as needed. Market conditions and your investment goals may change over time. Rebalancing your portfolio periodically ensures that it stays aligned with your desired asset allocation. For example, if certain asset classes have performed well and now comprise a larger portion of your portfolio, you may need to sell some of those assets and reallocate the proceeds to other underrepresented areas. 3. Seek professional advice. If you're unsure about the best diversification strategy for your portfolio, consider seeking professional advice from financial advisors. They can provide personalized guidance based on your unique circumstances and help optimize your investment plan. Financial advisors can assist in determining the appropriate asset allocation, selecting suitable investments, and monitoring your portfolio's performance. 4. Cost and fees. Keep in mind the costs and fees associated with diversification. Some investments, such as mutual funds or exchange-traded funds, ETFs, may charge management fees or expense ratios. It's important to evaluate these costs and consider their impact on your overall investment returns. Additionally, tax implications should also be considered when implementing diversification strategies. Conclusion. Diversification is a fundamental principle of risk management in investing. By spreading your investments across different assets, industries, sectors, regions, and time periods, you can reduce the impact of individual investments' poor performance and potentially increase your returns. Remember to align your diversification strategy with your risk tolerance, regularly monitor your portfolio, and seek professional advice when needed. That wraps up today's extended video on diversification techniques. We hope you found this information valuable and that it helps you make more informed investment decisions. If you have any questions or would like us to cover specific topics in future videos, please let us know in the comments below. Don't forget to subscribe to our channel for more finance-related content. Until next time, happy investing!